Hey, you into FEPI? It sounds weird, right? It's not just me. Like if I was 15 years old again, this would be hilarious. Anyway, we're grown-ups now. This is the REX FANG & Innovation Equity Premium Income ETF. And I gotta say, I think this is the ETF I've been looking for because it's possibly a fantastic alternative to the very popular YIELDMAX ETFs. But this is up to each of us to decide on our own. In this video, we'll go over the basics of the ETF, the pros, the cons, and a huge warning that all investors need to know about. In addition, I'll give you my take on if this ETF is more appropriate for investors compared to the YIELDMAX ETFs, and I'll give you some info on why I think right now is the ideal time for investors to get into positions that offer higher risk and rewards. Remember that I'm not a financial advisor and this isn't financial advice. And as always, let me know what I got right, what I got wrong, and what I missed in the comment section down below. FEPI seeks to provide monthly distributions, and it plans on doing this by investing in big tech, specifically the 15 stocks in the Selective FANG Innovation Index, and selling covered call out of the money options on the underlying holdings. These holdings are probably familiar to you, and they are AMD, Meta, Nvidia, Qualcomm, Broadcom, Apple, Micron Technology, Adobe, Microsoft, Google, Netflix, Salesforce, Intel, Tesla, and Amazon. And of course, a whole lot of options positions. We get all this for an expense ratio of 0.65%. Now, this is the part where I tell you about that sweet dividend yield, because if we're paying that high of an expense ratio, it should be 100% worth it. Well, it's a very new ETF with an inception date of October 11th, 2023, and it's actually only paid out one dividend since researching and recording this video. So its dividend yield at the moment is about 25%, which is ridiculously high, especially compared to something like SCHD, which is usually between 3 and 4%. But I can't emphasize this enough. We have no idea if this is normal for this ETF. Obviously, we as investors need to watch out for the fact that this ETF is basically in its infancy, and there's almost no market data for us to compare the fund's performance in. And the dividend yield of 25% might come down as the fund matures and as price changes occur. I'm personally fine with that so long as the fund is continuing to provide income and keeps up with the market while avoiding NAV erosion. Time will tell if that actually happens, of course. And it's also very possible that the yield could be even higher in the future. One of the things that I really like about this ETF is the fact that it's focusing on a small number of tech stocks. So an investor like myself that wants exposure to tech stocks and their volatility with the intention of profiting from it could find this to be a good fit for a portfolio. And just by looking at the companies this ETF is holding, it's pretty easy to speculate that the yield on this ETF, especially in bull markets, could be consistently in the double digits because volatile stocks and options trades have a good chance of generating high yield. But of course, we should slow down before we rush into the shiny new income ETF available and compare this at the very least at a high level to what I would consider comparable ETFs already available. Compared to JEPQ, obviously JEPQ has been around for a lot longer, and given that FEPI is more concentrated than JEPQ, I would expect FEPI to have more volatility both in price and in yield. That's both in an upward and downward direction. And as of now, FEPI is paying a significantly higher dividend yield. Compared to YIELDMAX ETFs, the main difference is that FEPI has a covered call strategy in which the fund actually holds the underlying stock, whereas YIELDMAX funds use a synthetic covered call strategy and they focus on one stock. In addition, FEPI's dividend yield can be similar to some YIELDMAX ETFs, but there are some even higher ones available. I think YIELDMAX ETFs, generally speaking, will outperform FEPI and JEPQ during bull markets, but the downside is likely also proportionately larger as well. So overall, I think FEPI is a nice middle ground of all three options. But that's just a theory and we'll need more data to know for sure. But from the fund's strategy, FEPI can likely see more growth since it holds the stock just directly, as opposed to something like YIELDMAX ETFs that use a synthetic covered call and doesn't hold the underlying stock. In addition, FEPI has less concentration risk given it has more holdings, and each YIELDMAX ETF focuses on one stock, but for the risk takers out there, this could be seen as a benefit if your conviction in a company is particularly strong. Personally, I like Google, Microsoft, and Amazon long-term myself, but I don't own any corresponding YIELDMAX ETFs currently because I'm not comfortable taking on the risk of holding the YIELDMAX ETF overall. I'm a younger investor with a 3-decade time horizon, so I personally would likely be better off investing in something like QQQ or maybe the stocks themselves, since covered call ETFs naturally limit upside. But for an income-oriented investor who has has conviction in a single stock and is willing to invest for high yield, a YIELDMAX ETF might be more for you. And if you want something a little less concentrated and has some potential for growth, FEPI might be a better option, assuming you can tolerate the risk, of course. Although I do want to emphasize, none of the ETFs we talked about in this video are intended for growth, and FEPI might be more resistant to NAV erosion than a YIELDMAX ETF because it holds the underlying stock, but that is highly dependent on the price of the underlying stock for a specific YIELDMAX ETF. Now, I think at this point, most informed investors that have an appetite for risk and a need for income would be okay with investing just a small percentage of their money into FEPI just to test the waters. But I do want to warn you of a major finding. After doing a little digging into the dividend distribution, it turns out that FEPI, for the moment, is returning capital. When I first saw this, I was a little disappointed, but I'm not going to throw this ETF under the bus just yet. Now, it's only been a month, but as we all found out with SPYI, a return of capital can mean tax advantages for us as investors, or it can mean the fund is simply returning investor money. Maybe this somehow ties into the fund's selling point of not needing a K1, which is a tax document for pass-through investments like an S-Corp and trusts. At this point, it's hard to tell, and I'd rather wait for more data and more answers. As this fund gets more popular, I'm sure the fund managers will provide more data, like how much of the holdings they use for their covered call strategy, and who really benefits the most from not needing a K1 form, and of course, what's the deal with the return of capital? Is the fund actually making money and the yield is classified as a return of capital for tax purposes? Or is this something to be concerned about that leads to NAV erosion? The best part for us as investors is we don't necessarily have to invest right now. We can simply wait for those answers. Those of us who want to take the early bet can go ahead and buy today, and those of us who want more data can wait. That's the beauty of personal finance. It's our decision. And I think you could have guessed by now, I'm not investing in FEPI at the moment because I want more information prior to putting my money into it. But here's why I like most risk-on assets in general for the upcoming months, and that includes YIELDMAX ETFs, FEPI, JEPQ, crypto, you name it. It's because of the Federal Reserve's recent take on interest rates. Now, the money printer isn't going full burr, but it seems that rate hikes have paused, and although it's unclear if they will come down soon, I think eventually they will, and a pause has clearly been taken as a good sign by the markets. So if what happened last time when rates were cut to basically nothing is any indicator, it means risk is back on, and assets that take on more risk might provide more upside no matter how illogical it seems. I think we all remember GameStop and NFTs. That, of course, is 100% speculation, and if you look hard enough, you will find data that points to rate cuts actually leading to market downswings. So basically, that means no one, including myself, actually knows what's going to happen, and that's just the truth of it all. But I think long term, we'll all be okay as long as we manage our own risk and try not to get too greedy when the bulls start running and stay invested when the bears take over again. This assumes we're all invested in the right balance of assets, of course. So here's 3 things I'm looking for before considering adding FEPI into my portfolio. 1, more dividend payout history, more specifically if the yield goes up or down and if it's true return of capital or a tax-friendly yield. Maybe one of the fund managers can help clarify this in the future. Number 2, price performance in line with the market. Obviously, I'm not expecting FEPI to keep up with the growth of stocks 100%, but at the very least, go up in value to some degree based on the expectations of a covered call strategy. And 3, performance against other types of covered call ETFs like the YIELDMAX ETFs or JEPQ, because every dollar invested counts, and I'm always looking for excessive risk or better alternatives. All right, that's what I got for you for FEPI so far. Let me know what your plans are in the comment section down below. If you found value in the video, let me know by clicking the like button, subscribe for more content. I'll see you in the next video, and of course, good luck in the markets.